Now recording. So what we'll do tonight, we'll first go over chapter 10, and then following that, we'll go over the homework from chapter 9, which won't be bad. So chapter 9, fraud. What do you all think of when you think of fraud? What's going on? It's a bad thing, of course, but what kinds of things do you think about? Stealing money, that's a big one. Embezzlement. Everybody wants more money. And some people will turn to fraudulent means to get. A lot of people certainly won't. It depends upon their own code of ethics. So I think for most of us, we believe that, well, it's someone else's property, we just don't touch it. So that's built into our code of ethics. We would never commit fraud. We just wouldn't. Now everybody thinks that way. Leave a stack of money lying around and what will you find? People take it. Oh yeah, slip a little bit out here and there. So embezzlement, huge one. That's classified as employee fraud, type employee fraud, because a lower level employee has the motivation to do that. What else do you think of when you think of fraud? Yes. Say again, please. Yeah, okay, inaccuracy of financial statements. Yes. Financial statements have been cooked. They've been made to look better than reality. Yes. Definitely management has that motivation. So that's a type of management fraud. We've seen management fraud and we've seen employee fraud. What else might you think of when you think about fraud?
Stealing property, inventory.
Good, very good, Christine. So stealing property, stealing inventory is one of the biggest types of property to steal. So if we think about fraud in a retail establishment, we might think about fraud as shoplifting, and it is a type of fraud. So customer stealing something. However, where do you think the bigger risk of fraud actually lies? Sorry. Employees, yes, employees, because a consumer can take a unit or two of the product out the front door of them. But an employee or a manager having access to more inventory in one fell swoop can take a bigger chunk of inventory. And the average employee theft is about 6 times what the average consumer theft is. So for example, an employee or a manager circumventing internal control could back a pickup truck up to the loading dock and take a carton full of some product. So much bigger take. By the way, in a store, what are some of the more common items which are taken?
Laundry.
Sorry?
Laundry.
Laundry?
Like sexy.
Oh, good point. Lingerie, yeah, absolutely. Yep. Most stolen thing at Target. That is very interesting. So, yeah, lingerie. Well, we know what people are thinking of. And that is a driving factor. It's a good point. What other things in a store might be taken?
Jewelry, it's worth a lot.
Good, jewelry's worth a lot, you betcha. Yep, nice sparkly jewelry, people love it. Or if they don't have it for themselves, they don't keep it for themselves, they might sell it. Yeah. So things to be sold, big ones. What else might we think of in a retailer that would be a big thing to be taken?
Electronics.
Good point. Electronics, expensive, people want them. And again, if the person doesn't take it for themselves, oh well, they'll just pass it along by selling it. Like on eBay. Or in A flea market. Yeah. If we went specifically to a grocery store, what kinds of things are hot to be taken in a grocery store? Big shoplifting items. Alcohol, oh yes, expensive. And if somebody's running a little business on the side, like a little catering business, oh, they have a deep desire for alcohol. Yes. Even if they're a teetotaler. Do people still use that word? Teetotaler? It means somebody who doesn't drink at all.
Non-perishable food?
Non-perishable food, you bet. And some of that can be very expensive and very subject to being taken. What else that's non-perishable is a big one? I can think of 3. Okay. Over-the-counter medications. That's why you'll sometimes see something like a little screen above you that shows you're being recorded. Yeah. So over-the-counter pharmaceuticals, baby items, huge. People need them. And another one that's really big, cosmetics. All high value, all expensive. They can be sold if somebody doesn't need that product for themselves. So tempting, tempting, tempting. Very tempting to steal these things. So we'll look at employee fraud. We're going to look at management fraud. We're not going to be looking so much at consumer fraud. From the standpoint of the auditor, we don't have to think about it so much, I guess, even though it's very interesting. And we also won't think about so much about fraud. For example, somebody getting ripped off by scammers, which is huge right now, and it's become even more huge thanks to the pandemic. I wish we did have time to look at these things. Also for fraud, if you're interested in fraud, I do teach a course in fraud at the graduate level, which is quite interesting. It's a 2-hour elective in the MAC program, and that does help prepare you to become a certified fraud examiner, a CFE. So if that's something you're interested in, certainly let me know. Even if you don't do the MAC, I can get you materials on that from the Association of Certified Fraud Examiners. So very, very, very interesting branch of not only accounting, but also of other things too. A few years ago, I was at one of their meetings in Tampa, and they had someone from the Secret Service there who was in charge of currency. I didn't realize Secret Service is. So he had some very good examples of counterfeit currency. There's another type of fraud. Now, I'm afraid when it comes to scammers, which state in the union tends to be #1 for scammers? Florida, you bet, by far. Yep, our beloved state. I'm afraid so. And we know why. Big vulnerable population here, I'm afraid. So, yep, unfortunately, we're #1. Now, a lot of types of fraud. So what I'd like for us to do tonight is to take a look at some conditions for fraud. Then we're going to get into how the auditor assesses the risk of fraud. And we're going to get into some types of specific management frauds and employee frauds. So we kind of scratch the surface here in this chapter, give you what you need for the CPA exam. But again, we can follow it up with more material if you come in the MAC program. And fraud is always inherently interesting. And it's amazing how people keep thinking of different types of fraud. Whenever there is a system of internal control in place, somebody is trying to think about how to get around it. And I must say that I'm grateful to most accountants have a great sense of personal ethics, and they don't take advantage of loopholes in internal control. I also say that because once you've studied internal control, you're likely to be able to discover loopholes in it. And internal control out there is not perfect. So I don't have students who take advantage of that, at least for the most part. I can think of a few who have, but that's a different story. Not at this school. So let's think about some conditions for fraud here. Well, first of all, what is fraud? It's any intentional deceit, that's a good term, meant to deprive another party of its property or rights. So somebody's getting ripped off. If we think about rights, we could think about all kinds of political fraud. There's another big piece of fraud, and I'm glad that we don't have to get into that in this course. By the way, periodically, it's been brought up, the CPA should be involved in elections. The CPAs should observe the electoral process and do what is called an agreed upon procedures engagement, which we study in the second auditing course. So just do those procedures that you agree upon with the client and try and make sure there's no voter fraud out there. How many CPAs do you think want to touch that one? I don't think so. No. Ooh, yikes. Tech lens. There. Well, an accounting fraud can involve fraudulent financial reporting. That's management fraud, or misappropriation of assets. That means stealing them. That's employee fraud. And in your book, there's something called the fraud triangle. And I'm just going to draw it up here on the board. It's something conceptualized by Donald Cressy. He was not an accountant. He was a famed criminologist. And it states that 3 factors must be present in order for someone to commit fraud. And for those of you online, I'm going to stop my share for a moment and go to the board. So just adjust my camera here. Okay. Oh, I see somebody was really tall. You can see it there online. Yeah, all the way up at the top. Well, some tall person wants to volunteer. That's great. By the way, given my heritage of being Jewish, how many Jews are all that tall? Let's face it, they're not. All right. So in looking here at this fraud triangle, let me just make sure that I get my elements of it in the same order I have them here on my notes. There we go. First of all, there is some incentive, some pressure to commit fraud. I'll discuss these here in just a moment. And then there is some opportunity. And additionally, we also are going to interact with the person's attitudes or rationalization. Sorry, I messed that one up there. Because down before, I've got this nice seam between glass panes. Those who design these classrooms, like I've said before, don't teach them. So whoopsie. So incentive, opportunity, attitudes. Let's talk about each of these. So some incentive or pressure to commit fraud. That's always there. People don't just commit fraud for the fun of it. Well, I shouldn't say that. Some people actually do. So the fun of it could be there, but usually there are even more substantive reasons to commit fraud. What do you think some of the incentives or pressures to commit fraud might be? What are some really common things? Financial trouble, you bet. I need money. So I might need money for myself. I might be leading an expensive lifestyle, which I don't, but I might need money for myself, which is why if we ever suspect an employee of fraud, where do we start looking? Sorry. Credit, yes, we can certainly look in their credit report. Absolutely. We might find a lot of past due bills or unpaid bills. Sorry. Collection, yes, accounts and collection. Very good. Where else might we look? Bank account, good. We could access something there. We could also look in the parking lot. Why do I say that? Yeah, they might be driving an expensive automobile and not earning too much. There could be an explanation. Could be a spouse that earns a lot, or they could have gotten an inheritance, but that's a sign. We also look at jewelry and clothes. If somebody is in a $30,000 job, but they have a great big diamond on, yeah, something like that. See where they live. Is that out of line with their income? Again, there can be good explanations, but maybe not. Another incentive is if they're running a business on the side and that business needs some money, or their spouse is doing so, or their spouse is running up debts, or in the case of, well, sadly, one CPA that I used to know, his son was needing money and he didn't really question the son, but what do you think the son was into? Drugs. Drugs, sadly, are a big reason for needing money. Yeah. Let's see what else. Also, another big thing is gambling. Another really big thing is gambling. Yes. The former auditor of my home county in Indiana one time asked the Indiana auditors, state auditors, when they came in, what was your most unusual story about fraud? And it was of this branch library just outside of Indianapolis, where there was a librarian in there who was stealing book reacquisition funds. Have I ever told you this? I can't remember. Okay. So let's replace edition 5 with edition 6, for example. Well, she was able to get the money, but she didn't replace the book. And there was no internal verification of this. So they just let her go. So pretty soon she discovered she could keep this money. And guess where she was going? Las Vegas. Yes. There was a flight from Indianapolis on Friday night that went to Vegas, and then another one coming back Sunday night, overnight, landing in Indianapolis like 5 a.m. She was taking those flights. So she was having herself wonderful weekends in Las Vegas. And I'm sure that many other people who were regulars on those flights were too. So they finally discovered her, and they said that she looked like a typical librarian. She'd been there for years too. Those are both signs we're covering something up. Sure enough. So she was indeed. They finally got her. Yeah. So, and also I will make sure that I share some slides with you. I'll send these to you about Judy Holter from Payne Air Conditioning up on Oleander Street, not far from here, who was stealing money from there, using it to buy lottery tickets at the Stop and Shop or Stop and Go, whichever it is, across from the library, near Mr. Fish. What I'm talking about. Little convenience store. Keep saying I want to eat at Mr. Fish. I've never been there. It's supposed to be good. Is it? Okay. Okay. I need to give it a try. Yeah. It's one of those things I keep saying I'm going to do it, but I haven't done it yet. So those are all big pressures or incentives to commit fraud. Sure, we can think of others too. Well, then number 2, the opportunity to do so. There's some loophole in internal control in a business. Judy certainly took advantage of that at Payne Air Conditioning because nobody was looking over her shoulder like the owner. Librarian in suburban Indianapolis was able to do that too. So, The opportunity was there. Nobody was looking. And that's why a lot of frauds, once discovered, they have mounted up to a large amount of money and they've gone for a long time. It was someone trusted, somebody who looked perfectly harmless in most cases. And then number 3, someone's attitudes or rationalization. Well, what that means, attitudes includes one's character or set of ethical values. We all have a set of ethical values. In most cases, our sets of ethical values have been shaped by Judeo-Christian philosophy, and someone may be Jewish, somebody may be Christian, but still, it's all the same in the end, trust me. So yeah, the set of ethical values is the same. But it doesn't mean that everybody abides by that set of ethical values, unfortunately. And also people are often in environments which pressure them to rationalize fraud. There's always some rationalization. Whoops, I didn't mean to do that. Or here's why I did. I just wasn't getting a raise or something like that. There's always some rationalization. So somebody also might be placed in an environment where management's committing fraud. And it's either you commit the fraud too, you go along with us, or you lose your job. And that's extremely unfortunate. Then, number 4, when you have a chance, we can see an example of these risk factors in the book and some commonly cited fraud risk conditions. So have a look at those when you have a chance. Quite interesting. And also, number 5, seeing the interesting characteristics of fraud perpetrators in the book on page 301. So I'll leave it up to you to take a look at those interesting things. If I had more class time, more time spent on fraud, we could go through them in depth. What we do in the second fraud class. Certainly, if you have any questions, you let me know. Well then, Roman numeral 2, assessing the risk of fraud. So here's where the auditor is going to come in and think, is there a higher risk of fraud in this company than another company? And for those of you online, let me go ahead and share my screen here again. Let's see, got one. Okay, good. No problem, Danielle. I know, Danielle, technical issues. We had one here in class because we couldn't get in the door at first. There's always a technical issue out there for every occasion, right? Yes. So assessing this risk of fraud, what the auditor does. Well, first of all, we know that we always maintain an attitude of professional skepticism. That includes questioning mind and critical evaluation of all that evidence. So auditors have to brainstorm about fraud as a team. Let's think about where fraud might occur, who might be doing it, etc. And some sources of information to assess fraud risks. Well, first of all, that communication I just mentioned about the audit team members. They should share insights, brainstorm ideas, and address the factors in the middle of page 304 that I referred to a bit earlier. Have a look at them. For example, is there anything about this company which might increase the risk of fraud? Definitely a failing company will. Someone like a brick and mortar retailer, it's going downhill. It's kind of like, well, it's going downhill. Why don't I just take some of this inventory? It's going to become obsolete. It's old stuff, truly. Inquiries of management. So management should identify any place where they feel the fraud could occur. They should come clean with us. By the way, here at Florida Southern, our auditors also do that with the audit committee. They go around the table, and I would have to state if I felt that any place within the Florida Southern system is vulnerable to fraud. And I don't think any place is. I don't. Well, it could always happen. But I don't think that any place is unusually prone to fraud. We tend to have a good team here. And, among other things, I must say, there's a very good so-called tone at the top, which we'll talk a little bit more in a few minutes. But at the top of the organization, there are really good ethical values. And in no small part, That's because this is a Methodist institution. It's a religious institution. Now, that doesn't always happen. We could point to Southeastern University and its unfortunate fraud about 3.5 years ago. Ooh, that's another one I could show you sometime. See, I know I got all this interesting information, but not enough time. I've got so much material to teach to get you through the CPA exam. But how their vice president for development, the fundraising guy, stole over $200,000 from them and was not prosecuted. Sad but true. Yeah, and here at Florida Southern, even though it's a Methodist institution, are most people Methodist? No, not all. No, about 20%. So, yeah. Methodists, by the way, run the most schools and the most hospitals of any denomination. And they have some very, very good ones too. And speaking of one of the really good Methodist schools, did you see a couple of days ago where Duke University had an outbreak of COVID? Yeah, like 180 cases stemming from one social event, and all undergraduate students have been quarantined. So big, big, big deal. But yeah, there's some really good Methodist institutions. Emory University in Atlanta, that's another one. SMU, Southern Methodist University. So yeah, they run a lot of really good hospitals too. So that's great. Really good denomination. Well, then risk factors. The risk factors we'll see in the book, again, like a failing business. And number 4, analytical procedures to identify unusual relationships. And these include detailed analysis of revenue, as fraud often involves manipulation of revenue. That's money coming in, somebody wants to take some. In fact, the auditing standards require the auditor presume there's a risk of fraud and revenue recognition. And 2 common schemes do this are premature recognition of revenue or fictitious revenue. And the auditor must also document the conclusions about revenue fraud risks. So, in other words, premature recognition of revenue, when will a business rather recognize revenue? This year or next year? This year. Yeah, they're forgetting about the consequences with next year. They don't think that far ahead. But let's get that last extra shot of revenue in a year in by making a deliberate cutoff error when it comes to sales revenue. Let's step it up. Let's don't record it next year. Instead, let's record it this year. Or just recording fictitious revenue in general. Fraudulent revenue. So again, revenue recognition, revenue in general, we've got some fraud problems. Well, one really good way of trying to reduce fraud risk is corporate governance, and I was just referring to that. So the tone at the top of the organization is one means of doing it. Let's see some things here. Well, management is responsible for preventing and detecting fraud within the organization, and is always more effective to focus on fraud prevention and deterrence. Let's nip it in the bud and not let it happen. Well, management should implement anti-fraud programs and controls to reduce fraud opportunities. Good internal control definitely does. And management should also communicate fraud detection and punishment policies to deter employees from committing fraud. For example, if you commit fraud, you're going to lose your what? Job. And we'll prosecute. That's another one, unlike what Southeastern University did. And what do you think about donations to Southeastern after this happened? They went down, yeah. Because in a not-for-profit, if you have fraud going on, donors see that as losing their dollars and they just won't contribute. Yeah. So I know they've had a big drop-off over there. Well, then in B, management should also promote a culture of honesty and high ethics. And the most effective way to prevent and deter fraud is to implement anti-fraud programs and controls which are based on core values embraced by the organization. And these reinforce acceptable behavior and expectations which employees can use to guide their actions. And creating a culture of honesty and high ethics includes this. So let's create some great expectations for everybody that we're all honest here. Well, setting the tone at the top is one of the biggest ones. Certainly, that's true here at Florida Southern. Another really good example of this is Publix. Excellent tone at the top. And they promote that throughout Publix. Oh yeah, employees feel like owners, and they want to make sure there's no fraud too because they feel like they're being ripped off. Their employee stock ownership program has been one of the best things Publix has ever done. Top management of Publix, very, very honest. Again, they promote that throughout the organization. And as you know, we have a lot of interaction here with Publix. Most of the top brass of Publix, the owners, like the Jenkins family, they are also what? Think about religion. Which religion do you think they are? Methodist. Oh, yes. They are Methodist. Very much so. George Jenkins' daughter, Mary Barnett, his family's Jewish. Anyway, when it comes to one's beliefs, one's attitudes toward fraud, one's work ethic, etc., Methodists and Jews tend to be a lot alike in general, a whole lot alike, which is why a lot of big donors here are Jewish, just like the Weinstein Computer Science Center being built next door. So very, very good meshing there. Of course, somebody can be perfectly ethical and have no religion, and they're welcome here at Florida Southern too. I know people here who are like that, and they're very respected. So religion's not a catch-all, but it can help. It can help. And then number two, creating a positive workplace environment, including a whistleblowing process, which is why our auditors always look right at me there at the table in audit committee meetings and what you know that could help us assess the risk of fraud. They put it just like that, you know, if anything that could possibly be going on, or an environment where something might go wrong. And well, I have to answer honestly. And I've always answered, I cannot think of anything. And I can't. But if I knew of something, I would have to bring it out. And I would also have to do that as a CPA, because to maintain one's CPA license, one has to be honest, to put bluntly. You can't be a prey to fraud, even by not reporting it, because then you're condoning it. And that's not good. And somebody at State Board of Accountancy, if they got this in a complaint against you, could actually take away your CPA license. It's more likely to happen to someone in public practice than to someone here in education, but it could happen. By me, an enemy on the Board of Accountancy. Yikes. Well, number three, hiring and promoting appropriate employees. Just like we were saying, checking out their credit reports, doing background checks. And those things are not foolproof. A lot of people that commit fraud, when they're discovered, they have no criminal history, like Joey Holcher, but it is an important thing to do, just in case. If they had done that over at Southeastern, I forget what the guy that ripped them off had done in the past, but there had been some other shady behavior. He wasn't convicted, but in his job history. So he was not an angel. Number four, sufficient training. Make sure that people understand what fraud is. Make sure they understand what some fraudulent actions may be. And don't do these things. Sufficient training also helps them spot fraud. Then periodic confirmations from employees, just like the audit committee gets from me, or having employees sign once a year on a document that they know of no fraud and know of no possibilities where fraud might erupt. And then discipline. If somebody commits fraud, they have consequences, including losing their jobs, including getting prosecuted. Any questions there so far? All righty. Well, then management. Management's also responsible for evaluating fraud risks on an ongoing basis. So if we have good internal control, but if fraud's occurred anyway, let's find out why and let's nip that reason in the bud. So this includes taking steps to reduce identified risk, like I said, as well as monitoring internal control, which helps prevent and detect fraud, one of the best things to do so. And fraud cannot occur without a perceived opportunity to commit it and to conceal it. So management should do the following. Well, they should also identify and measure fraud risk on an ongoing basis. And management needs to recognize fraud as possible and could be committed by virtually all employees. And when you have a chance, see Figure 10.6 for the impact of anti-fraud controls on fraud deterrence. A lot of these really deter fraud. Things like employee training and what fraud is and how to spot fraud, huge. So you'll see these things in the book. And then number 2, mitigating any fraud risks, like changing internal controls necessary if we identify there could be a fraud. Then monitoring fraud prevention programs and controls. And that's particularly important for areas with high fraud risks, like with revenue, with inventory. And this can be assisted by an internal auditing function. Very much so. Publix has a good internal auditing function, and yes, indeed, they're always looking at reducing possibilities of fraud, management fraud, employee fraud, and consumer fraud, taking stuff from the store. Also, by the way, Publix is one of the biggest targets for counterfeit currency. Yeah, and the guy who was at the Association of Certified Fraud Examiners meeting actually had some currency, counterfeit, which came from Publix. And I remember there was one team, a father and son team, who was just going down the coast, Publix to Publix, and taking supposed $20 bills and buying packs of gum. So $20 bill is the most counterfeited bill around. We think of a $100 bill, but actually stores take a lot of precautions there in general, so they don't get counterfeit. 20s come in all the time. So $20 bills are the most commonly counterfeited unit. So they were buying all these packs of gum with counterfeit $20 bills. So they got lots of change, and the change they got was genuine. So that was their little scheme. I don't know if they actually did them or not. I'm sorry, yes.
The thing about that is I worked at a nonprofit where we dealt with cash, and I received some counterfeit. I'd go to the bank every Monday after events to deposit. And when they get the counterfeit money at the bank, they take it. You're just out the money, even though you supplied the gum and the change in real money, then Publix lost the $20.
Wow, thanks, Karen.
Yeah.
So Publix just lost it. Their loss, and they lost a $20 bill, and they lost a pack of gum there. Yeah, that's a really good point, Karen. So always beware. Yes.
So if the bank does take $20 and the customer, when the voice of fraud money comes back with a slip, we can actually get reimbursed. So I work for Publix, so we'll send it to the bank that we got the slip money. If there was something that came from us, we can send it to the bank, and the bank will reimburse us for whatever money that they provided to us that was counterfeit.
Okay. So if the bank provided you with counterfeit $20 bill, they didn't catch it, then you can get that money back from them. Okay, that's good. Now it's been a few years now since this father and son team hit the Gulf Coast. I don't know if you'd heard about that one.
No,
Okay. And I know, like I said, Publix had a lot of instances of counterfeit currency because they're a great big grocery store. And that's one of the first places people think about getting rid of counterfeit currency. Yeah. Well, then number 4, I talked about being on the audit committee here at Florida Southern. And audit committee oversight is a big one. And the audit committee has responsibilities for overseeing the organization's financial reporting and internal control processes, and should consider the potential for management's override of internal control, because it can sure happen. Management takes advantage of their position and can circumvent a lot of familiar things with internal control, like passwords and, well, lots of other big things too. So that's why we really want a good management team in there. Well, then D, the auditor's responses to the risk of fraud involve 3 levels. Overall responses, kind of at the top, and then responses at the assertion level, so individual accounts, individual transactions, and response related to management override of internal control can always happen. So let's look at overall responses first. So overall responses to fraud risks focus on increased fraud risks. So what really pops out as that fraud could occur here? Any place cash is involved or inventory is involved or another vulnerable asset, big. We have a lot of internal control there. So auditors should discuss the relevant facts with management and obtain management's views of the potential for fraud and to gain insight on existing controls designed to mitigate the possibility of fraud. We feel they're doing a good job there or not. Auditors should also consider whether the existing controls really do decrease the likelihood of fraud and whether any deficiencies exist. So should things be improved or not? And more experienced audit staff may be needed to be assigned to the team, including a fraud specialist. That can be very helpful. And professional skepticism should definitely be ramped up. We really don't believe something until we see evidence. Auditors should also consider management's choice of accounting principles, especially those which include subjective measurements or complex transactions, because those can make fraud easier to commit. That has been a valid criticism, by the way, of IFRS when it comes to fair values of assets, because fair values are often very subjective. Whenever we have subjectivity, and if somebody is being pressured to commit fraud or has the incentive to do so, they might lean towards something which makes it easier to cover fraud up. A complex transaction also does, because people just don't understand totally what's going on. Well, auditors also consider management's choice of accounting. What am I doing? The auditors especially need to examine revenue recognition policies because, again, revenue is often involved in fraud. And since fraudsters usually are very familiar with accounting policies, auditors should also incorporate unpredictability in the audit strategy. Because if the fraudster knows what we're going to look at next, what will the fraudster do? Clean it up. Yeah, make it look really good. And auditors should also include tests which address the misappropriation of assets, stealing assets. So yes, stealing cash, stealing inventory, other assets too. Computers, laptop computers, big draw. Well, then if we go down to the assertion level, thinking about specific accounts, specific transactions going into them, well, responses to fraud risk at the assertion level include audit procedures to respond to specific audit risk related to the account or audit and the type of fraud risk examined. And the auditor may need to change the nature, timing, and extent of audit procedures, including increasing sample size. We might have to increase our sample size so that we assume less plan detection risk, less of a chance that something slips by us. Greater sample size, we're looking at more items, we decrease plan detection risk. And again, we always want to be unpredictable there. Well, then number 3, response to address management override of internal controls. Those include recognizing the management can always override internal control, take advantage of their position. For example, if President Kerr would like to, she could. Do you think she ever would? No, she wouldn't. No, her personal ethics are way beyond that. Well, therefore, management's in a unique position to commit fraud by overriding controls which are otherwise operating effectively. So here are some things the auditor should do. Our auditors do this. Examine journal entries and other adjustments for evidence of possible misstatements due to fraud. Fraud often results from misstatements and adjustments to amounts in financial statements. That's especially true of top-side adjustments made by management, because these come down from above. Management says, ooh, let's tweak that depreciation, adjusting entry at year end. So adjustments, they can get a little bit shady, shall we say. They can reflect fraud. And B, we should also review accounting estimates for bias. Management always has a motivation to oversee assets and revenues and understate liabilities and expenses, and we know that. Fair values of assets often represent an area for deliberate misstatement as well, like I said with IFRS, because a lot of subjectivity is there and it's easy to fool someone. Then C, we should also evaluate the business rationale for significant unusual transactions, because those can indicate fraud. We need to look at them. The auditor should determine that the accounting treatment is appropriate and that the related information about the transaction is disclosed in the financials. Because with fraud, do you think the fraudsters want a lot of disclosure in financials? Let's cover stuff up. Well, otherwise, such transactions could definitely be a vehicle for fraud. And then D, auditors should also be alert for the following. Any discrepancies in the accounting records. Detailed tie-in isn't there. It could be because somebody tried to take something like some money, but they didn't follow it all the way through. It happens. Then number 2, any conflicting or missing audit evidence. It could even be manufactured audit evidence. Oh, well, fraudulent audit evidence trying to mislead us. Then number 3, any problematic or unusual relationships between the auditor and management. Do you think the fraudsters are always cooperative with auditors? Not always, no, certainly not. We've seen that in politicians a lot when they're committing fraud. Instead of admitting to it, what do they do instead? Become even more grandiose, even more pompous. Then number 4, any results from substantive or final review stage analytical procedures, that substantive in the middle of the audit, final review at the end of the audit, they indicate a previously unrecognized fraud risk. Ooh, here's something that doesn't look too good. And responses to inquiries made which are vague or implausible or which produce evidence which is inconsistent with the information. They just didn't answer our question. That again happens a lot with politicians, and we've seen it. Bear with me just a moment here. Well, then some specific fraud risks. Let's look at some specific areas that represent fraud. A lot of these will be very, very, very understandable. First of all, revenue and accounts receivable. Well, management has the motivation to overstate both, as we know. And in fact, more than half financial statement frauds involve this area. So as an auditor, we pay a lot of attention here. Also, since sales for cash which are quickly converted to cash. Whoops, I need a which in here. I wonder that wasn't making sense. There. Sales for cash or something quickly converted to cash, like on accounts receivable. Cash is also highly susceptible to theft. Everybody wants more cash, and that is why, in a nutshell. And revenue is the largest account on the income statement. Think about that one. And a misstatement involving only a small percentage of revenue can have a huge effect on income because revenue drives everything on the income statement. And revenue growth is also a key performance indicator of analysts and investors. So they like to see revenue growing. If it's not, they don't look so fondly upon this company anymore. And the timing of revenue recognition is often very subjective. Also prevents an opportunity for fraud. Like I said, stepping up revenue from next year to this year. So at the end of 2021, let's hope it's a better time, by the way. Well, stepping up 2022 revenue to 2021 revenue. If a company can get by with that, that's a last extra shot of revenue at year end. Never mind, they took away from 2022 because they're not thinking that far ahead yet. And the timing of revenue recognition is often very subjective and prevents an opportunity for fraud. And auditors also need to be on the lookout for the following. Fictitious revenues. Let's just sneak them in. Fictitious customers often come into play here too. They're created. Yeah, a good example of fictitious customer right now with COVID. Think about a sports event like basketball in an indoor arena. Who are fictitious customers? They're often generated. Anybody know? Cardboard cutouts of spectators. Yeah, some of them look really realistic too. And here at Florida Southern, they were doing a little promotion from basketball where you could actually buy one of these for the school. So if you look out there, you think, wow, that arena is fairly crowded. Not by paying customers. So again, premature revenue recognition and and manipulations of adjustments to revenues as a big area of suspect because management could be trying to increase revenue. So any adjustments to any account can be suspicious. And then fourth, stealing receipts involving revenue, including failure to record a sale and theft of cash receipts after a sale is recorded. And the latter may also involve recording a sales return or allowance. So somebody brings some merchandise back and we should record that, but maybe the employee records some extra sales returns or extra sales allowances. Money should have gone back to the customer, but where's that money go instead? Employee's pocket. Yes. It happens. Or the employee steals the inventory that came back. By the way, which do you think an auditor would rather see? A sales return or a sales allowance? Any idea? Sales return. Because there is physical merchandise being returned. A sales allowance instead is based upon the employee's subjectivity. Oh, I'm going to knock $50 off this for the customer because customer's a little bit dissatisfied. Could be knocking the $50 off, the customer didn't get it. Maybe the customer didn't even know about that, but can go in the employee's pocket instead. It's a major place where you have to look. Also, not recording a sale can be a big one for employee fraud. One area where this occurs is in any type of business having a lot of cash coming in. A really good place for this is in a bar. Think about that. A lot of cash coming in. Once somebody has a few drinks down them, how careful are they with their money? They're not. So bartender may be on the take there. Now, independent convenience stores, there's another one. Nail salons, hair salons. And then number 5, analytical procedures. They often indicate unusual or sudden changes which can affect fraud. And I'll let you take a look at table 10.4. It's very easy when you have a chance to look at some examples that stem from here. Then inventory. Well, we know management has the motivation to oversee inventory. They would love to overstate any asset. And fraudulent financial reporting on inventory often involves fictitious inventory, especially at multiple locations. That's a good way to baffle people. Also, sometimes inventory is not written down to lower cost or market, but it should be. And analytical procedures, again, can help detect inventory fraud. I'll let you look at the examples there in the book. Again, very easy. Also with inventory, we know that there is the severe possibility of employee fraud. They love take some too. Management fraud, overstay inventory. Employee fraud, understay inventory. Then accounts payable. Well, management often has the motivation to understay accounts payable like any other liability. We don't know that much. And this can happen by not recording accounts payable increases like purchases until the next fiscal year. Let's push them off from 2021 to 2022. 2021 looked better, but 2022 not looking as good. Or by recording fictitious reductions to accounts payable, like a fictitious purchase return or purchase allowance. Very, very mirror image of sales returns and sales allowances. And also a common employee fraud involves issuing payments to fictitious vendors and depositing the cash into a fictitious account. So, issuing payments to fictitious vendors. GD Holcher Payne Air Conditioning was doing some of that. So here's a payment going out to a vendor. Well, actually what happened was it went to her and she was depositing that in a phony account, which she had. She was able to get an account opened at, I think, SunTrust or Fifth Third, one or the other, in which sounded like Payne Air Conditioning, but it wasn't. She used her credentials to do that. And she used that as a personal checking account. So this is a big way of doing so. To reduce that, if we have more time, we could look at a lot of reduction activities that we could do. But one big thing here to reduce that, and we do see more about in the second auditing course, is to very carefully monitor any vendors. We need an authorized list of vendors. If the employee makes payment to one of them, that's fine. We know where it's going. But if the employee is trying to make a payment to someone else, some other vendor, they should get management's approval to do that, because otherwise it might be a fictitious vendor. Well, then fixed assets. And these are large amounts with rather subjective valuations. Ooh, subjectivity, possibility of fraud, and therefore represent a tempting area to manipulate. Management would like to overstate them if they could. A management, for example, may capitalize repairs or other operating expenses as fixed assets. That happens a lot. From the same company where you get fixed assets like Payne Air Conditioning, buying a new air conditioning unit, you also have repairs coming from. So management might try to capitalize those repairs. And also, as I said, fixed assets are targets for theft because of their value and their saleability, especially assets which are pourable, like a laptop computer, a lot of inventory. And such assets should be engraved and inventoried. So my computer's not. It is inventory, but it's not engraved. Well, then if we look at E, intangible assets, and those are based on accounting estimates, and their valuations may be subject to valuations by management. So again, subjectivity coming into play here. Auditors may even have to consult business experts here because intangible assets are, well, just plain old intangible. Very subjective. Then F, payroll expenses. Management could record excess payroll expenses as inventory, and that happens strangely. Also, fictitious employees can be created or individual employee payroll hours could be inflated. And where do you think this extra money might go? Into the hands of management. So it's kind of a combination of management fraud and employee fraud there. Well, then Roman numeral 5, some auditor responses when fraud is suspected. First of all, increased use of inquiry. And note the interesting cues to observe in people's expressions and other feedback, which are in your book. Again, take a look at them when you have a chance. And the textbook also includes some other facts related to inquiry. I won't test you on these things, but just good to look at. Helps you spot when somebody's lying. On software analysis is another place we can look, especially as artificial intelligence grows more and more. It's being used to help detect fraud. We can also have expanded substantive testing So in other words, do things like increase the number of confirmations of accounts receivable and accounts payable you send out, bigger sample size. And of course, in D, all this must be documented. And then in E, see the interesting chart of fraud detection methods in the book. One of the biggest ways to detect fraud, by the way, is by customer tip-offs, which is why sometimes in stores, you'll see some sign that if you don't get a receipt, you'll get some little reward. They're trying to make sure that this employee gives you a receipt. They're trying to make sure that this employee did not simply ring up your purchase and then maybe you pay cash. And where'd that cash go? Employee's pocket. Yes. Well, good. So our chapter tonight did not take nearly as long as I thought. And we'll be doing some homework in just a bit. Yes. The excess payroll expenses and inventory act like instead of spending this money on an expense, they spend it on inventory instead. And since payroll is very complex, sometimes they can get by with that. So they would rather show they spent that money on an asset and thereby increase assets than on an expense, which would increase expenses and thereby decrease operating income. Payroll being very complex, and also in a manufacturing company, since a lot of payroll is direct labor, you might try to increase the amount of direct labor that you show, and then that in turn is capitalized in work in process inventory as direct labor is applied on the assembly line. That's a common place where it happens. Does that make sense? But sometimes management is even more bold than that, and they just try to act like it was an inventory item they purchased from an outside vendor, even if it's not a manufacturing company. So sometimes people overstep their bounds, and that's when they often get caught. And they've probably been doing this fraud for a long time, and they think they're flying under the radar all the time, but karma finally came to them. What else do you have here so far? So yeah, since I front-loaded this class in the beginning of the semester, as we were all told to here at Florida Southern, now we can have some more time for relaxation and really think about the content of chapters. And that's great in auditing because we've gotten through the basic tools and now we're applying those a lot. So that is neat. So yeah, I can slow down somewhat from what's on the syllabus, and that's good. More time to absorb. Plus, quite frankly, when it comes this time of the semester, how tired do people get? Pretty tired, yeah. I'll certainly extend my accounting lab deadlines. So just self-pace on that so that you don't get a lot of stuff stacked up. When is better for me to show an official deadline? Is it as we go through week by week between exams? Or is it better for me to have the chapters for the exam due a few days after the exam so you can catch up and, if need be, and correct anything? Obviously, I expect you to do the homework and quizzes on the chapters I test you on before the test. I mean, that's what homework and quizzes are meant to do. But is it better for me to go ahead and have an official deadline a few days after the exam so that you can spruce things up? Pardon? Which deadline do you like? One after the exam. Okay. All righty. Any other opinions? So do you like that deadline, a few chapters after the exam? Was that helpful? Okay, Lisa. Okay. So why don't I do this? For those chapters that will be on the upcoming exam, and I need to go back and look, I will extend the deadline on those until a few days after the exam. That is with the expectation that you're still keeping up and you're still doing the homework and quizzes as I go along. But again, to wrap anything up, like to try to increase your score, you can do that after the exam once your mind is cleared. After all, this is college. Should I be having to monitor when people do everything? Not really, right? And in practice, again, people who are successful in jobs don't have to be monitored. Yes, I'm sorry. Let me see what I can do. They lock a lot of that down to prevent information being leaked on websites, etc. At the very, very least, you can always email me, and I'm happy to. Okay. Next exam, let's have a look here. Oops. Next exam is March 31st, 2 weeks from today. It's coming up kind of quickly. Then we see, okay, we're counting it down. 13 and 24 will not be. So probably through chapter 12. That's my guess, yes. And 8 through 12, that's my guess. That's right. On my lab, I don't have 11 and 12 homework if it's going to be overloaded here in the middle of the semester. So go ahead and do it. But it's penalty free. Or I should say you can elect to do it on my accounting lab. Or if you want to just do it on pencil and paper, that's fine too. It's up to you, just for your own learning. Yes, it's off my lab completely. I'm sorry, that's right, it's off my lab completely. So just do it for your own learning. Homework only, no quiz. And again, you don't have to turn in homework or anything like that for 11 and 12, just for your own learning. And let me take that back. Chapter 12 may not be on this exam. Let's think here. No, chapter 12 will not be. We will not have a chance to go over homework. So 8 through 11, 4 chapters. That's good. You can really, really, really learn those chapters. So what other questions do you have here so far? Oh, and for those of you online, go ahead and stop my share here. Here we go. So anybody online have a question? Certainly, as you all do, let me know. Always want you to feel part of the class. Oh, and Leona, is Kitty up there? Oh, let's see Kitty. Oh, Kitty, you've got pretty green eyes. Always up there. Constant companion, huh?
I got
Good.
one too. She's
Oh,
studying.
who's that? Oh, Christine. Yeah, so whoops, I'm on double screen there. And yep, Christine, you've got yours too. Another constant companion, huh? Yeah, mine is too, especially when it wants to be fed. Oh yeah, they can get very persistent. And well, I guess we're there to serve them. Their own private restaurant.
This is her dinner time, so she's very, very insistent about being right in my face right now.
I know the feeling, just exactly. Mine tends to get underfoot and I have to watch all the time if I don't want to step on the poor guy, but he's very persistent. Oh yes. Alrighty, well, I'd like for us to go over some homework. I'm going to go upstairs and get my book. So if you want a little break here, just a few minutes, I'll be back with that. Alrighty, we'll take a look at homework here. And for those of you online, I will share my screen and you'll see my book. My ebook specifically. There we go. So first section that we had, of course, were some basic review questions. Before the multiple choice questions, did you have any questions about the basic review questions, or those go okay? Okay, all right. So multiple choice questions, some old CPA exams. Again, I always want to go over all of these because we see the common types of tricks to try to lead us into and common reasons why wrong answers are wrong and right answers are right. So it's not just enough to know the content. We also need to know how to take that specific exam. So the first thing about assessment of the risk of material misstatements. Well, first of all, which of the following circumstances would most likely cause the auditors to suspect that there are material misstatements in the entity's financials? And which one did you say? 2. Very good. Significant differences between the physical inventory count and the accounting records are not investigated. This must be a perpetual inventory system they're talking about because the accounting records show the perpetual inventory master file. In other words, how much inventory should be there. Physical count doesn't match up, and they don't even bother to investigate why. That's bad. Well, then in B, which of the following statements describes why a properly designed and executed audit may not detect a material misstatement in the financial statements resulting from fraud? Wow, say that 3 times fast. I don't think I care to. So, number 1. Whoops, I gave it away. Sorry, you all were going to say 1, right? Okay. Audit procedures that are effective for detecting an unintentional misstatement may be ineffective for an intentional misstatement that is concealed through collusion. That one's kind of long too. So, unintentional misstatement, there is no cover-up. Something intentional, and there's collusion involved here, that makes it even more complicated. We might not detect it. Then C, prior to or in conjunction with the information gathering procedures for an audit team members should discuss the potential for a material misstatement due to fraud. Very true. Which of the following best characterizes the mindset that the audit team should maintain during this discussion? What did you say? It's actually 4. Questioning. And they bring this up on the CPA exam, so you'll know the answer right off the bat. Good. It's good to know some answers right off the bat, and that is certainly one. So, looking at number 26, concerning the audit risk model. While some account balances, such as those for pensions and leases, are the result of complex calculations, the susceptibility to material misstatement in these types of accounts is defined as, what did you say? 3, inherent risk. That means the risk of a material misstatement assuming no internal control. These are very subjective to those. So, high inherent risk, to tell you the truth. Complex calculations, that keys into something that is very complex. There can be a lot more susceptibility to misstatement, whether it's innocent or whether it is fraudulent. Well, then in B, as the acceptable level of detection risk decreases, so planned detection risk goes down, the auditor may do one or more of the following except change the, what did you say? 3, extend audit procedures by perhaps using larger sample sizes. Well, if we used a larger sample size, inversely planned detection risk would decrease. The premise of the question is, whoops, And whoops, let me see something here. I think I have a note in my book. Oh, no wonder. Okay, I just plain old gave you the wrong response. Goodness gracious. Number 4. Except change the assurances provided by audit procedures to a lower level. We wouldn't do that. In fact, if we want plant detection risk to go down, inversely, we would use a larger sample size, which automatically means number 3 is not correct. You can also see another little trick they often use. Find the wrong answer, because our minds are geared toward finding the right answer in questions. So when you see except, or which one's not right, well then in C, inherent risk and control risk differ from plan detection risk in that they do what? Number 3, exist independently of the financial state audit. They are independent variables. Well, then 27. Following questions deal with audit risk and audit evidence, and as always, choose the best response. So which of the following does not increase the need for sufficient, that means enough, appropriate, high-quality audit evidence? So it does not increase the need for that. Which one did you say? It's number 4. A decrease in the assessed inherent risk, because if inherent risk goes down, that means audit evidence also goes down, a direct relationship. So always know those relationships between the risk and the audit risk model and the amount of evidence to be gathered. Because they do test those on the CPA exam, not only is it because it's important, but also they know that people often get those reversed. Then B, as lower levels of both audit risk and materiality are established. So we're more conservative there. The auditor should plan more work on individual accounts to, number 1, find smaller misstatements, because we're being more conservative. We're concerned with smaller stuff here. Then C, based on evidence gathered and evaluated, an auditor decides to increase the assessed level of control risk from that originally planned. So increase assessed level of control risk. That means internal control is not as good as we thought. We're increasing control risk. So problems with internal control, that also points to more evidence, because we know the amount of audit evidence and control risk are directly related. So to achieve an overall audit risk level that is substantially the same as the planned audit risk level, the auditor could, and that would be which one? Actually, they have a typo here. There's where the note in my book was. Number 1 is the correct answer according to the book's official answers. However, they mean a typo. Number 1 should be decrease inherent risk, because if control risk goes up, inherent risk goes down by the same amount, the denominator of the audit risk model is still the same. Therefore, the risk of material misstatement would still be the same. That was not a good question. Okay. Any questions on the multiple choice? Okay. We have one problem, which was number 34 on page 290. And this one deals with the audit risk model here too. So following our 6 situations that involve the audit risk models is used for playing audit evidence requirements in the audit inventory. So we'll see some things here, high, medium, and low. Well, first of all, explain what high, medium, and low, or I'm sorry, low, medium, and high mean for each of the 4 risks and planned evidence. Okay, so let me go ahead and stop my share here for a moment. So I think about low, medium, and high. So they did not give us specific numbers here. And the reason why they didn't is because the risk model is not subject to precise calculation. Neither are the individual risks. I'm sorry, somebody, oh, I thought I had something. Okay. Yeah, if you have a question, just let me know, no problem. Thought it was a question coming about. Well, as you have the risk model, again, it's not subject to precise calculation. Neither are the risks going into it. So those risks, we can assign values like high, medium, and low, rather subjective, rather a range involved as we think about each one. And in fact, how many risks in life are subject to precise calculation? Not a lot, no. Some things we know are 100%, like, well, as Benjamin Franklin said, you got it, thank you, Lisa, death and taxes. Yep, we know those will come about for all of us. In fact, what did the IRS just announce? That's right, by a month. Yes, I guess that is a final decision. So instead of April 15th, May 15th. But again, let's just make sure it's a final decision before we actually postpone pay. So high, medium, and low. And we're to think about each of these broad risks and what that means for the amount of evidence. Broad risks, I'm sorry, I should say audit risks. So we'll think about those risks and relationship to evidence. Plan detection risk, as we know, has an inverse relationship to evidence. If you want to decrease plan detection risk, you'll gather more evidence. Because plan detection risk is the risk that a material error slips by the auditor. Gather more evidence, you decrease that risk that you don't find it. Conversely, if you decrease your evidence, you're going to increase your plan detection risk. More of a chance that you don't find the thing that's wrong. Then we saw in the denominator, control risk and deterrent risk. Actually, let me get those in order, the order that we saw them. We saw inherent risk first. And yep, they've got that in the book there too. Those both bear a direct relationship to audit evidence. Make sure if you can't see something on camera, just let me know. Got it all? Okay. So inherent risk, the risk the account has an error in it, assuming no internal control. Well, the lower that risk is, the better the account is, to tell you the truth, that means less evidence we must gather. Something like land, very low inherent risk. Something with high inherent risk, such as cash, we must gather much more evidence. Control risk. Again, direct relationship to evidence. Again, we always need to know these relationships to evidence. But control risk is the risk that internal control is not working, that internal control does not prevent and or detect material error. If control risk is high, that means internal control is not working. We must gather more evidence. Conversely, if control risk is low, internal control is working, less of a chance that material error slips by us. We want low control risk. Direct relationship to evidence, the lower control risk is, the better, because we gather less evidence. Something that we also mentioned is the risk material misstatement. The risk material misstatement is inherent risk times control risk. That's how big a probability in an account that may contain a material error. We want risk material misstatement to be low. That means directly we will gather less evidence. Makes sense because the account has a lesser likelihood of a material error in it. Well, it's probably okay, even before we get there and do the audit. Then acceptable audit risk means the chance that we issue a clean opinion when we shouldn't have. It's subjectively set by the auditor and applies at the overall level of the audit. It doesn't vary from one account to another like inherent risk and control risk do. So it's subjectively set. We would set low, for example, with an SEC company, because we don't want to assume much of a chance that we issue the wrong type of audit report. There is an inverse relationship to evidence, because to drive down acceptable audit risk, we want less of a chance that we issued the wrong audit report. We must gather, in that case, more evidence. So there's an inverse relationship to evidence there. Then in B, we've got to fill in the blanks for plan detection risk and planned evidence using the terms low, medium, or high. And for this, I kind of wish they'd given us some numbers so we could crunch the numbers, but they didn't. So that's okay. We'll take care of this. And for those of you online, let me share my screen again so that you can see what I'm going to be doing here in the book. So again, low, medium, or high, we're doing B. A couple of these may be a little bit difficult to ascertain, but I've got the official answers from the book's answer key here, and therefore the official answers from my accounting lab. Okay, number 1. Planned detection risk would be high. Planned evidence would be low. By the way, planned detection risk and planned evidence are always inverse. So since I've said high for planned detection risk, planned evidence is low. Then number 2, medium and medium. So medium for both planned detection risk and planned evidence. I guess medium flipped with medium is still medium. Okay, so I say I wish they'd put some numbers here. So medium and medium for number 2. Number 3, planned detection risk is low. Inversely, planned evidence is high. So number 3 is low and high. Number 4, same thing, low and high. Numbers 5 and 6 are also the same thing, medium and medium. So 5 and 6 are medium and medium. Anyone like for me to read one of those back? Did you get them? Okay. Then C, using your knowledge of the relationships among the foregoing factors, state the effect on planned evidence, either increase or decrease, of changing each of the following 5 factors while the other 3 remain constant. So let me go ahead and stop my share here. I'll just read off the requirements as you look on the board and see these effects on audit evidence. So first of all, a decrease in acceptable at risk. If acceptable at risk goes down, inversely evidence goes up. So the answer is increase in evidence for number 1. Number 2, a decrease in control risk. Control risk goes down. Directly evidence will also decrease. So evidence will decrease. Number 3, a decrease in plan detection risk. So PDR goes down, evidence goes up, inverse relationship. So evidence will increase. Number 4, a decrease in inherent risk. Inherent risk goes down, and directly evidence goes down too. So again, a decrease in evidence. Number 5, a decrease in inherent risk and an increase in control risk of the same amount. They're trying to say that inherent risk goes up and control risk goes down, or vice versa. They're trying to say they just flip numbers. So if so, the risk of material misstatement will remain the same. The denominator, therefore, would remain the same. Therefore, plan detection risk remains the same too. So the answer is there is no effect on evidence. Still the same amount. And would anybody like for me to go back over any of those? Give me an answer that you didn't get. Everybody's okay. All righty. Well, that takes care of homework for tonight. And as I said, we can start having the dividend of time in this class. That's good because things can still get into a greater extent. We've got the basic tools that we needed for auditing, and now we're looking at some very specific things. That's good. So I will go ahead and declare the rest of time tonight lab time. So do anything that you need to. And next week then, we'll be getting into the next chapter. So we did chapter 10 tonight. Next week, chapter 11 and the chapter 10 homework. All right, so no questions or anything? All right. Also, by the way, happy St. Patrick's Day. Like most of us, I didn't wear green either. Oh, well. By the way, do a lot of us have Irish ancestry? No? You do? No, I do too. Yeah. So, I forget, has anyone been to Ireland? Oh, wow, look there, Leona. You have Irish ancestry? No, okay. Has anyone been to Ireland?
I have.
Yeah, how'd you like it, Lisa? Yeah, me too. Good people, very good people. So it's a good place to travel too. So it can be on the bucket list for finally when we get done with this pandemic. Yes. All right. So happy St. Patrick's Day, and I'll look forward to seeing you next week. So everybody take care. Take care online. All right. Bye-bye.